Financial management and securing funding are critical pillars that support the launch, growth, and sustainability of any entrepreneurial venture. This module delves into the comprehensive and multifaceted world of finance, tailored specifically for entrepreneurs. Managing finances effectively allows entrepreneurs to optimize resource allocation, ensure liquidity, minimize risks, and maximize profitability. Funding, on the other hand, represents the lifeblood that fuels business operations, expansions, and innovations. Understanding various funding sources, how to access them, and managing investor relationships are fundamental skills every entrepreneur must master. This module is designed to equip learners with a broad and deep understanding of financial principles, management techniques, budgeting, accounting basics, funding options, and financial decision-making, all contextualized within the entrepreneurial journey. The importance of financial management in entrepreneurship. Financial management involves planning, organizing, directing, and controlling the financial activities of a business. For entrepreneurs, it is crucial to maintain cash flow, ensure there is enough cash to meet operational needs and unexpected expenses. Budget effectively. Allocate resources to various business functions efficiently, make informed decisions, use financial data to guide strategic and operational choices. Monitor performance. Track financial health through ratios, reports, and KPIs. Manage risks. Identify financial risks and put in place mitigation measures. Failure in financial management is a common reason many startups fail, making this a critical area of focus. Key financial statements every entrepreneur should know. Income statement, profit and loss statement. Shows revenues, expenses, and profits over a period. It helps entrepreneurs understand profitability. Balance sheet. Displays the company's assets, liabilities, and equity at a specific point in time, giving insight into financial stability. Cash flow statement. Tracks inflows and outflows of cash, revealing liquidity and the ability to meet short-term obligations. Understanding these statements allows entrepreneurs to assess business health and communicate effectively with investors and lenders. Budgeting and forecasting. Budgeting is the process of creating a detailed plan that outlines expected revenues and expenditures over a set period. Forecasting predicts future financial outcomes based on historical data and market trends. Types of budgets. Operating budgets, capital budgets, cash budgets. Purpose. To control costs, plan investments, and avoid cash shortages. Forecasting techniques. Trend analysis, scenario planning, and sensitivity analysis. Accurate budgeting and forecasting help entrepreneurs anticipate financial needs and align spending with strategic goals. Sources of funding for entrepreneurs. Entrepreneurs have access to a variety of funding sources, each with pros and cons. Personal savings, using one's own money, often the first source. Family and friends. Informal loans or investments from close connections. Angel investors. Wealthy individuals who provide capital in exchange for equity or convertible debt. Venture capitalists. Firms that invest larger amounts in high-growth potential startups. Bank loans. Debt financing with repayment obligations and interest. Crowdfunding. Raising small amounts from a large number of people via online platforms. Grants and competitions. Non-repayable funds from governments or organizations. Bootstrapping. Self-funding the business by reinvesting profits. Understanding which funding source aligns with business stage, industry, and growth plans is critical. Financial ratios and key performance indicators, KPIs. Financial ratios help interpret financial statements and benchmark business performance. Liquidity ratios. Current ratio, quick ratio, measure ability to meet short-term obligations. Profitability ratios. Gross profit margin, net profit margin, return on assets, leverage ratios. Debt-to-equity ratio, assess financial risk. Efficiency ratios. Inventory turnover, receivables turnover, evaluate operational effectiveness. KPIs are customized metrics that track specific goals such as customer acquisition cost, burn rate, or revenue growth rate. Financial decision-making and risk management. Entrepreneurs must make financial decisions under uncertainty, balancing risk and reward. This includes decisions about pricing, investments, debt versus equity financing, and resource allocation. Risk management strategies involve diversification, spreading investments or revenue streams, insurance, protecting against unforeseen losses, contingency planning, preparing backup plans for financial shortfalls. Real-world examples. Spotify's strategic use of venture capital to fund rapid growth while managing cash flow constraints. Local startups leveraging microfinance loans to bootstrap operations and scale sustainably. Entrepreneurs using crowdfunding platforms like Kickstarter to validate ideas and raise capital. In summary, financial management and funding are complex but indispensable facets of entrepreneurship. A solid grasp of financial principles, mastery of budgeting and forecasting, knowledge of funding avenues, and application of financial analytics enable entrepreneurs to sustain and scale their ventures effectively. This module prepares learners to navigate the financial landscape with confidence and strategic insight.